Hello, welcome to session 5 of Ugbs 204, Macroeconomics for Business. In the last session, we spoke about the simple Keynesian system, where we looked at how aggregate demand determines the level of equilibrium output in the short run. Today, we are going to continue with that by looking at the meaning and then the use of fiscal policy in this framework. So essentially, this session will be about how fiscal policy is used to stabilize output around the full employment output. That is how fiscal policy is used to mitigate the effect of recessions. At the end of this session, it's expected that students should be able to explain the concept of autonomous tax multipliers and then autonomous spending multipliers, and explain the concept of fiscal policy, identify the types of fiscal policy, and also be able to explain how fiscal policy works using the simple Keynesian system. So the main topics, as already indicated, are the meaning of fiscal policy, how fiscal policy works in the simple Keynesian system, and then how fiscal policy is used as a stabilization tool. The main reading list for this is pages 345 to 352 of the book by Mankiw and Taylor. So let's start off by trying to explain exactly what fiscal policy is. Now, fiscal policy generally refers to changes in the level of government spending and taxes that are meant to influence the economic activity. So whenever we mention fiscal policy, either the government is spending more or collecting more in taxes, or spending less or collecting less in taxes. Either of them is fiscal policy. So mostly when the government when the budget statement is read, it's really a statement of the government fiscal policy for the year, because the budget will tell us how much government plans to spend and how much revenue government plans to correct. So when it comes to announcing new tax measures, for instance, in the 2016 budget, which was read in November 2015, you record that there were new tax measures. New taxes were imposed, and then some taxes were also revised upwards. All those constitute fiscal policy measures by the government. Now, broadly speaking, fiscal policy may be classified into two. It can be either expansionary or contractionary. So expansionary is when the government trying to boost economic activity by increasing the level of spending and or reducing the level of taxes. So when government spends more or collects a fewer amount of taxes, then it's doing what you call expansionary fiscal policy. Now, expansionary fiscal policy is also called loosening. So when in the textbook, you are likely to read that it is called expansionary, but if you hear it in ordinary language, when people speak in the popular press, they are going to call it fiscal loosening. So when you hear fiscal loosening, it's the same thing as expansionary fiscal policy. The other part is contractionary fiscal policy, and that's where government try to tighten. So contractionary fiscal policy is also called fiscal tightening. So under fiscal tightening, the government is either trying to reduce its spending and or collect more tax revenue. So in particular, you recall that the current IMF program that the government is undertaking, that's the Extended Credit Facility with the IMF, is essentially a fiscal tightening measure. So you see that under the IMF program, we are collecting new taxes. So the government is imposing new taxes, and then also is trying to reduce its spending. For instance, you may have heard that they are trying to clean up the payroll to reduce the total amount the government spent. That's a fiscal tightening measure. And then also trying to introduce new taxes. A whole lot of new taxes have been introduced since the last budget. All those are called fiscal tightening measures or contractionary fiscal policy. So our goal is to try and understand how fiscal policy works in the simple Keynesian system. In session 4, we looked at how we work things out how the equilibrium is determined in the simple Keynesian system. So if we said that, in equilibrium in the simple Keynesian system, output is determined by aggregate demand. And then we saw two scenarios where we assumed that there was no government and there was no external sector. So in that case, aggregate demand was simply consumption and investment. And later on, we relaxed that assumption by allowing there to be government. And we said that when there's government, then it means that government is going to spend. That is the G component. And then also government collect taxes. That's the T. So we learned that to solve this system, you use the equilibrium condition that aggregate demand equals output. So when you set Y equals AD, and then you look at the components of aggregate demand, in this case being C plus I plus G, you're able to show the expressions that we have in the slides. Now, so when we try to study fiscal policy in this system, we are trying to understand the effect of changes in G or T. So remember, fiscal policy is about changing spending and taxes. So when we want to study fiscal policy in this framework, we are trying to understand how an increase in G or a decrease in G, or an increase in T or a decrease in T will affect the equilibrium. And that's what we spend most of today's lecture doing. Now, but before then, we need to revisit a concept that we introduced at the last session called the autonomous spending multiplier. Now, going back, we indicated that if you look at the equilibrium expression we have, if you look at the equilibrium condition, the equilibrium that we solved, all the terms in the second term on the right-hand side, that is, all the terms in the bracket, are the items that we call autonomous expenditures. So we are talking about A0, T0, I0, and G0. We call them autonomous expenditures. So when we study fiscal policy, we are going to try and understand the effect of change in T0 and then also G0 on the level of equilibrium income. But we are trying to recall a concept that we introduced in session 4, that is autonomous spending multiplier. Essentially, last week we saw that if any of the items that we call autonomous expenditures, if any of them change, we explained that the equilibrium income will change by a multiple of the initial change. And that multiple is what you call the autonomous spending multiplier. So we introduced autonomous spending multiplier and we showed that it was 1 over 1 minus B. And that's what we call the autonomous spending multiplier. It essentially tells us it's a multiple by which equilibrium income will change when any of those components change. Okay, so here in the simplified framework, the components of autonomous spending are A, I0, and G0. So if any of those things change, then equilibrium income will change by a multiple. Now we are also going to introduce a similar concept called the autonomous tax multiplier. The autonomous tax multiplier it measures the response of a change in autonomous taxes on equilibrium income. So note that if you recall this equilibrium equation here, we've said that I0, and G0 are what the autonomous expenditure component. Now the T0, when there's a change in the T0, the effect on equilibrium income is going to be a multiple. That particular multiple is what we call the autonomous tax multiplier. To see how that is derived, we simply have to take the derivative of the equilibrium equation here with respect to T0. So if you differentiate this expression with respect to T0, we are going to get minus B over 1 minus B. And that's what we call the autonomous tax multiplier. Now, the reason why it has a B is because taxes and then equilibrium income will move in the opposite direction. So if equilibrium income increases, if taxes increase, the equilibrium income will fall, and vice versa. And that's why the tax multiplier has a negative sign. Now, the tax multiplier is a multiple by which any change in autonomous taxes will change the level of equilibrium income. So finally, we introduce the concept of the balanced budget multiplier. The balanced budget multiplier. Now, the balanced budget multiplier tells us what will happen to equilibrium income if government changes spending and taxes by the same amount. Recall that if you start with a balanced budget where the total level of government spending is equal to the total level of taxes, that means that the budget is balanced. If government increases spending by, say, 50, and it is financed by increasing taxes by 50, now the effect of that on equilibrium income is what is captured by the balanced budget multiplier. Now, you expect that if taxes change and spending change by the same amount, some people might think that it will have no effect on equilibrium income. Well, the balanced budget multiplier is 1. In the example that we've seen, the balanced budget multiplier is 1, telling us that if you change spending and taxes by the same amount, actually equilibrium income will change. It will change by the exact amount. And to see this, we are just going to have a simple illustration. So first, we are going to increase government spending by changing G. And we've already seen from the autonomous tax multiplier that if you change government spending by this much, the equilibrium income is going to change by the change in government spending multiplied by the multiplier. Okay. On the other hand, if you change taxes by delta T, then it's going to change equilibrium income by delta T times negative B over 1 minus B. That is a tax multiplier. So consider the case where we change the change in G, that's delta G and delta T are the same. So if delta D and delta G are the same, then the joint effect of these on equilibrium income can simply be obtained by summing up the effect of the change in G and the effect of the change in T. So we are going to sum these two components. But because the change in G is equal to change in T, we can replace, when we look at this part, we can replace the change in T with change in G. And that will give us this expression here. So when we simplify this expression, we are going to get G times 1 minus B over 1 minus B, which is exactly change in G. In other words, if you increase spending and taxes by the same amount, equilibrium income will increase by that amount. If government doubles its spending by doubling tax collection, equilibrium income will double. That's what the balanced budget multiplier tells us. So here's a simple numerical example for us to consider. So in this case, the economy has the following. Consumption is 100 plus 0.8 YD. Investment is 200, a fixed amount. Government spending is 80, fixed amount. And then autonomous taxes, that is lump sum taxes. We spoke about that in the last session, is 70. Well, in this case, note that when you write this consumption function, it means that the marginal propensity to consume is 0.8. So we consume 80% of every additional disposable income. Now, from this example, we can calculate what the autonomous spending and tax multipliers are, because we said that the spending multiplier is 1 over 1 minus B. So in this example, B is 0.8. So when we plug it into the formula, we can show that it is 5, and then the autonomous tax multiplier is negative 4. Now, we can then solve for the equilibrium income. Remember, the equilibrium condition is that in equilibrium, income equals aggregate demand. So if you sum up the components of aggregate demand, then we are going to get, we'll be able to show that equilibrium income in this system is 1620. Next, we are going to look at how we can use fiscal policy as a stabilization tool. In other words, if the economy is fluctuating, how can the government use fiscal policy to stabilize the economy? That's what we mean by fiscal policy as a stabilization tool. Now, here, before we go on, we introduce a couple of new concepts. That's to make a distinction between what we call potential GDP and then the output gap. Now, the GDP that we calculate for the economy is the actual GDP. Now, we define the concept of potential GDP. Potential GDP refers to the total GDP the economy will produce if all the resources in the economy were fully utilized. That is, if the economy reached full employment and optimally utilizing all its capital and available resources, how much output can it produce? We call that potential output. Okay, potential output or potential GDP. Now, the difference between the actual output we produce and the potential output is called the output gap. The output gap is the difference between the potential GDP and the actual GDP. So, as this expression tells us, this is how we define the output gap. So, in this case, YP is the potential and Y star is the actual. Now, if the output gap is positive, that is, if the potential output is greater than the actual output, we say that we have a recessionary gap. So that is the special name given to a positive output gap is a recessionary gap. On the other hand, if the output gap is negative, that is, if the potential GDP is lower than the actual GDP, we have an inflationary gap. The unusual scenario, the unlikely scenario where there's no output gap, that is, where actual GDP is equal to full employment GDP or the potential GDP, we have full employment. And so here we have a graphical illustration of both the recessionary gap and the inflationary gap. So the recessionary gap is on the left-hand side. So you realize that in this case, Y star here is the actual output, and then YP is the potential output. So you see in this case, the potential output is greater. So we have the recessionary gap. And then on the other hand, the inflationary gap is when the actual GDP is greater than the potential GDP. Okay, so how do we use fiscal policy as a stabilization mechanism? Well, when we say stabilization, we mean that we are trying to keep output, the actual output, as close as possible to the potential output. So our goal is to stabilize output around the potential level, and that's what stabilization means. So how can the government stabilize the output, the actual output, as close as possible to the full employment? Well, in general, if we have, let's return to the graph here, the graph we just seen. Consider a case where we have, on the left-hand side, we have a recessionary gap. Well, what that means is that the equilibrium, that is the intersection of the aggregate demand or aggregate expenditures and the 45-degree line, gives us an output of Y star. In this framework, we say that the aggregate demand is too low. Okay, so what fiscal policy can do is for the government to embark on an expansionary fiscal policy. That is to increase its spending and or reduce its taxes. Now, when either of that happens, we realize that the level of aggregate demand or aggregate expenditures will increase. So it's going to shift this curve up. So if the government spends more or reduces tax collection, it's going to shift this curve up and bring us closer to our full employment output or the potential output. And that's how government can stabilize the economy around the full employment. On the other hand, if you consider this case, you realize that the level of spending is way too high compared to what we need to be at a potential output. So this is going to have inflationary pressures. Later on, we talk about inflation. But what government can do is to reduce the level of aggregate demand. or aggregate expenditures. And to do this, it will have to embark on what we call a contractionary fiscal policy or fiscal tightening. So that fiscal tightening is going to reduce the level of aggregate expenditure and then make sure that output will get closer to the potential output. So that's how stabilization, the fiscal policy can be used as a stabilization tool. To consider a numerical example, let's record the example we just saw, which the economy that had these parameters, and we saw that the equilibrium income or the actual output was 1,622. Now assume that the potential output or potential GDP for this economy is 2,000. Notice that this will mean that we have a recessionary gap because the potential output is higher than the actual output. So we have a recessionary gap. In such a scenario, the government can use expansionary fiscal policy to increase equilibrium GDP and bring it as close as possible to the potential. Now, in the example that we have, we see that the output gap is 380. Now, because of the concept of a multiplier, we know that if government wants to increase equilibrium income by 380, it doesn't have to increase its spending by 380. And that it only has to increase it by a fraction. And that fraction we obtain by simply dividing the 380 by the 5. Because we know that in this example, the spending multiplier is 5. If government increases its spending by 1 unit, we know equilibrium income will increase by 5. Therefore, the way we can calculate how much government needs to increase its spending is to divide the total gap by the multiplier. So that's exactly what we have here. So when we divide the output gap by the multiplier, you get that the government has to increase its spending by only 76. So if government increases spending by 76, you can show that equilibrium income will increase by 380, and therefore the output gap will be closed. So finally, there are two more concepts that we need to talk about when we talk about fiscal policy. And one is automatic stabilizers and crowding out. Automatic stabilizers. Automatic stabilizers refer to inbuilt features of the economy that ensures that output is stabilized around full employment. So for these ones, no deliberate policy or no deliberate change in policy is required by the government. So, for instance, during recessions, what government wants to do is to boost the level of aggregate demand by increasing the level of spending. But ordinarily, this will require passing of a new budget. For instance, it has to go to Parliament to increase the level of spending. But with automatic stabilizers, the government doesn't do anything. These measures automatically kick in. They kick in when they are needed. So examples include unemployment insurance or compensation, and then also progressive tax system. So to explain how these serve as automatic stabilizers, assuming that you have recessions. When you have recessions, then some people lose their jobs. Now, ordinarily, if you allow these people to go without incomes, it means that it's going to reduce the level of aggregate demand for goods and services. But if the government is paying people unemployment insurance, it means that they are able to get some income and then keep spending, even though they've lost their jobs. That will ensure that aggregate demand will not fall as much, and therefore it will help dampen the effect of the recession on spending. So that's an example of automatic stabilizers. Obviously, in developing countries like ours, we don't see unemployment insurance. But in developed countries, unemployment insurance is very prominent. When people lose their jobs, in the period that they are looking for jobs, the government pays them some small amount to ensure that they still they are able to maintain some level of spending. So that's very important. We call those automatic stabilizers. Finally, when we talk about fiscal policy, one common thing that's commonly discussed in the popular press is what we call crowding out effect. Crowding out effect of fiscal policy. Now, generally, when government borrows, when government conducts an expansionary fiscal policy, it usually borrows. And when it borrows, it's going to increase the demand for goods and services. So later on, when we study the goods market a little bit more extensively, we learned that when government borrows, it ends up increasing the demand for loans. And in general, that is going to push the cost of loans. That is the interest rate. So when government borrows by increasing the interest rate, it's going to end up making the interest rate higher for all the private sector. So it means private businesses who also need to borrow from the same loanable funds, they are going to have to pay more to borrow. And that means that it's going to reduce the amount of investment that the private sector can make. Now, the tendency for government increasing its spending to reduce private sector spending is what is popularly called crowding out. So that is a popular concept that you usually hear with fiscal policy. That's it for today. Just to quickly recap what we've done today, we have focused mainly on fiscal policy. And we said that fiscal policy refers to changes in the level of government spending and or taxes that affect the level of economic activity. We indicated that there are two main types of fiscal policy: expansionary fiscal policy and contractionary fiscal policy. Expansionary fiscal policy or fiscal loosening occurs when the government increases the level of its spending and or reduces the level of its taxes. And then contractionary fiscal policy or fiscal tightening occurs when the government tries to reduce the level of its spending or increase its tax collection. We also explained that fiscal policy can be used as a stabilization tool to stabilize output as close as possible to its potential output. We also spoke about automatic stabilizers, which are inbuilt mechanisms that ensures that the economy by itself doesn't stray away too much from the potential output. And finally, we also spoke about the crowding out effect of fiscal policy. In particular, crowding out effect of expansionary fiscal policy occurs when an increase in government spending increases the interest rate for the private sector and causes private spending or spending by businesses to fall. Okay, so the main reading material for this session is taken from the Mankey and Taylor textbook, and which is part of the reading list for this course. So that's it for today. I will see you in the next session.